A seller reasonable pricing? Because one of the things we've seen, well, not just now, we've seen it over the years, that sellers are unreasonable in pricing. Why? And the other question we get a lot of times: why would anyone sell, a property that's making money?
Yeah. So there was some motivation on the seller side. He wanted to use the liquidity from the sale to buy another deal. So the guy that we were dealing with is a pretty major player in the market. He's got over 100 deals in the market. He's actually still a seller now because he's bought deals so far before that he's okay with letting a few go and maybe not making a peak pricing if he can use it somewhere else. So this is a little bit of a unique instance. Not everybody's doing that right now. A lot of people are holding on to deals or they're trying to get as high a price as possible. And it's not working out. This guy definitely had a motivation to sell, and he was realistic about where that pricing needed to be in order for it to trade. See, the market always speaks. It doesn't matter. You can list the property at a super low dollar amount going out there or a super high dollar amount. And guess what? It doesn't matter. What matters is if there's multiple eyeballs looking on that site, and let's say you undervalue it, you list it too low, someone's going to say, well, I'll pay this. Or if you list it too high, someone's going to say, well, I'm not going to pay that. Everybody's going to kind of converge around that same price point. So you may get a couple outliers, some up here, some down here, but it's all the guys that are overpaying typically are guys that are not as experienced and have a lower chance of closing. The guys that are paying less are more established and they know that they have a higher chance of closing. So as far as pricing goes, this guy was reasonable. We were actually the first ones to see this deal because of our reputation as a buyer in the market. No one else had seen it yet. We were able to reach a deal with the guy and move ahead.
Now you're talking about it's one of the better counties in Georgia, actually coming Georgia. And one of the things we did like about it is there were very, very little affordable apartments in this area. We talked about this earlier because it was so new, shiny, and there was a lot of money in coming. In fact, they're building a lot of new apartments as well. And so that's one of the other things that we liked about this that there's just not a lot of options there. Now you mentioned about the construction, right? There was a way to actually force appreciation. So what was the business plan for this property?
So the business plan was to create a better product in the market. So like Michael said, in this market, there's very few options to be in that mid-range pricing. Everything is pretty much A class in the market because it's just a booming market. There's a lot of new development. And so some of your infill locations they're filled with A class. They don't have, you're not finding a lot of that B, C class product. And there's still a need for that because there's still people that work in the market that want to pay less for their rent. Not as they don't want to move in A class. They want to stay somewhere in the middle. And so we knew there was an opportunity to kind of bridge that gap. There's a lot of classic product in the market and not a lot of like classic that have some upgrades to them type of product. So older vintage, but look newer. And so with this specific property, we knew we had the opportunity to go and create that. And that's what we're doing right now. And you're basically going in and you're upgrading. You're not spending a ton of money, but you're spending enough to make it look really nice, provide a good house or a good home for somebody, and then charge a little bit more for rents.
Yeah, so it's a fairly straightforward value add business plan. You just clean things up, you renovate some things, and you make it just a little bit nicer. And therefore, there were some, not many, there was maybe one or two comps where the other owners had done that, and of course their rents were a little bit higher. Therefore, you can then slowly raise the rents. So the other question to ask then, what is the business plan? Does the business plan make sense? And the other question to ask as an investor, and especially if you're an operator marketing a deal, you should disclose some of the risks, right? You should say, hey, this is not a risk-free thing, right? If you say, hey, there's really nothing can go wrong, you should never invest in a deal like that. So what are some of the risks that we identified for this deal?
Yeah. So the first risk that you're going to find really in any deal is the operational risk. So if you're not established, if it's we won't go buy a really small deal in a random market on its own because you may not have the support staff to be able to run that thing, right? So it's all about the people at the end of the day, and you need to have someone that can run the site in order for it to operate properly. And so this was a smaller deal, but it was a really good bolt-on deal to our existing portfolio. So for an example, if we lose a maintenance guy, we don't have any support there, we can bring resources from our other sites over to this one to help cover it. And so that's like pretty key when you have a deal like that's a little bit smaller, whatever. That risk is, we felt like we mitigated it fairly well because of our economies of scale in the market. The other risk is that get in and you can't raise your rents. It's not getting what you thought you're going to get. It's a very real risk out there. So the way that you kind of bifurcate that is you go to all the comps personally. So in person, you show up and you see what they're getting for their rents, and you ask them questions about their community. Hey, how long have you been charging this? What amenities do you guys have? What specials do you offer? All these things, and you really understand the landscape. We will visit sometimes 10 properties to understand what that looks like, and then have all the data. What are all these people charging? What product do they have? And how can we match that or exceed it when we get into our business plan? And so that's the best way to mitigate it. It's not just looking at data on CoStar. It's actually going and visiting these sites and showing up, understanding what your competition is. And so, go ahead.
What about the construction that's going on? Cranes everywhere, right? You read about,
Yeah.
oh my gosh, all this apartments coming online. Is that a risk?
Yeah, so oversupply is definitely a risk in the near term in general, because you have a lot of new apartments coming online. So our idea was not to try to compete with that product. We want to be in a completely different asset class, and we're not trying to push up into A-class rents. We want to kind of stay in our lane as far as that goes. But if you're trying to come in the market with a new product and compete against the A-class, you're going to take a hit in the near term when there's oversupply. There's a lot of building there in the last couple of years. During COVID, there was just a ton of building because interest rates were so low. That has shifted, and that product's getting delivered now, and we have a new product that's not starting. So there's going to be a shortage soon. It's going to take a few years to work through that, but that is a risk. Yes.
Let's talk about some of the projections before we talk about our assumptions, because again, to me, the projections, I take them with a grain of salt, because like I said, I can make my projections say anything I want, but what were we projecting in the deal?
Yeah, so this deal was pretty straightforward. It was going to be a 1.9x equity multiple, so almost 2x.
What does that mean?
Yeah, which means that if you put in $100,000, let's say as an example, our goal is to get you in a 5-year time frame, 190,000 back in your pocket. And it comes in two ways. It comes through cash flow, so every quarterly distributions, and then it comes at the end when we sell, and that's going to be where the main part of the profit comes from. So you get all your principal back plus an additional 90,000 over a 5-year period, and that's how these investments work. Additionally, you're going to be able to take advantage of typically tax advantages of the deals, bonus depreciation, things like that. And so that's another benefit that people really like of investing in these types of deals.
So, there's a multiple is one way to express the returns. What about average annual return and or cash on cash return? Define those as well. And then what were they?
Yeah, so cash on cash return is just for the dollars that you put in the deal, what percentage you're being distributed to throughout that year, essentially. And so our initial assumptions, it used to be higher. It used to be a situation where you're paying the banks less in interest, so you could pay investors more, and shifted a bit. And now what we're seeing is you have to pay the banks more while you're in the deal. So because interest rates are higher, so there's a little bit less of a cash on cash return. It's around 5%, which isn't anything to write home about. But the trade-off is that the values have gone down so much. We're talking 30 to 50% from the peak. So there's a lot of built-in equity into these deals. And that's what's so exciting about where we're at right now. So you're shifting it where the majority of your profit's going to be on that back end, but there's always the potential to go even higher than what you thought because of how low the pricing is right now. So there's that. And then what you see a lot of is IRR, or average annual return. So internal rate of return. That's just a fancy way of saying what your overall return is going to be over a specific period of time. That's your internal rate of return, and typically anywhere between 13 to 17% right now is pretty good on that. And then average annual return is just a different way of calculating that. It's not really based on time as much. It's just based on annual return. So that typically you see that go up. It's a little bit of a higher number on the average annual return. So that's what you'll see in general when you're evaluating apartment complexes. Those metrics are kind of circulating the cash on cash. Maybe there's a pref in there to help with the cash on cash. So a preferred return where the investors get all the cash flow without any going to the operator. That exists out there sometimes. And then your IRR is a typical metric that you'll see on any apartment deal.